Joe, the Fed has been flying blind for a while because of the government shutdown. What are your Fed expectations heading into the end of 2026?
Well, I mean, it does seem like the Fed's going to take a pause here in December. I mean, this is a Fed that's overly transparent. Powell said at the last meeting that not to expect a cut, or it's not a foregone conclusion that we're going to get a cut. The most recent Fed speak says that, we may be more concerned about inflation and maybe a pause would be appropriate. There's certainly a faction that wants lower rates, and that'll come into play in 2026. But for right now, it does seem like the votes are leaning towards a pause in December with a changeover in 2026.
Okay, well, they better be worried about inflation and they better be worried about jobs. Those are their two mandates. So what are your thoughts about both jobs and inflation? And then in turn, what do you think the Fed's going to do?
So, the Fed's admitted that the tariff inflation could be a one-time hit, right? So the prices go up, but then they kind of smooth out over time. But still, that's still an increase in prices, and that's detrimental to a significant portion of the population. So you could argue whether it's in their purview or not to be concerned about this K-shaped economy that we keep talking about. But every meeting, Powell comes out and he talks about how inflation is disproportionately affecting the lower income portions. So it seems to me like that is the needle they're trying to thread, willing to wait. Jobs are obviously an issue. It was top of mind last meeting, but this somewhat of a 180 they pulled at the end of the meeting seems to think that they're more focused on inflation, and we're going to let it ride for at least this meeting.
Okay, so while they're threading that needle, what should investors be doing? Should they be running out and grabbing yield? What should they be doing?
Well, we like to say entry points matter. So rates could certainly go lower, and fixed income returns have been very strong this year as rates have come down. But if you think about where we are, 2-year rates are about 100 basis points higher than their 10-year average. 10-year rates are 150 basis points higher than their 10-year average. There's been $1.5 trillion of investment grade debt issued this year at an average of 5.25%. High yields even better, over 7.5%. So that's a good entry point for fixed income, especially if you look at the equity markets, where this might be the third year in a row where we have over 15% equity returns, which that doesn't happen very often. So you may want to think about rebalancing and grabbing some of that yield.
So all that cash we hear about on the sidelines and money markets, all those billions and billions, you think they're going to come back into the fixed income as opposed to the equity markets? And if so, exactly where? Is it going to be in munis, treasuries, high yield? Where's it going to go?
So if I go back to the top, I don't think the Fed cuts next meeting, but in 2026, there is a bent for rates to come down. You'll have a new Fed chair, you'll have new members. They may be more aligned with the administration to see rates lower. Your cash investor most likely is going to take a step out into short duration. And we think that makes sense. Cuts would directly impact the front end of the curve, and you see some capital appreciation. The long end doesn't have to move, but the front end would. So for the cash investor who may be a little bit more risk averse, short duration might make a lot of sense.
And then finally, if they're going to be bringing money into those short duration fixed income vehicles, should they do it through active ETFs? Because that's really been a very hot story over the course of 2025, all the money heading into active ETFs.
Yeah, we would agree. I mean, a lot of financial professionals that we talk to are starting to embrace the active ETF wrapper. They like the flexibility, they like the duration, or duration management, at least on the fixed income side. But they like the tax efficiencies that an ETF can bring to the table that a mutual fund can't. Hartford Funds has launched a series of active ETFs over the years. We just launched an additional one 2 months ago, the Dynamic Bond ETF, which offers, again, flexibility in credit and duration, but the tax efficiency is really what we're starting to see these financial professionals embrace.
All right. Well, thanks for coming on and talking about it.
Thank you.